It is time. Some more Secret Wars. And I'm just afraid that it's going to mean more questions. I did do a little bit of research on stageanalysis.net. And they have a nice section called the Sell Stop Guide. And there's actually some good demonstrations on charts on where the entries, trader sell stop, investor sell stop, and some reasoning behind that, some debate, some of the members, and just chatting along, asking questions. I think I asked a few myself, but it was enlightening. It makes me, it's like back one of my, the thing is with Stan and the system, 20, 25 years. But I know that the way I'm trading now, well, before my Stan revisited the adventure, my system evolved, my framework patched from different things I've seen over the years, originally from Stan and then from Peter Brandt and classical charting, stock charts, and all this other where I get my information to fit I tweaked it to fit my personality, so it'd be I'd have less chances of landing on emotional landmines. And maybe Stan did along the way adapt his system. Was some information like why Stan had investors set their sell stop the way they do, and some of the reasoning behind that was to please maybe some of his clients, to not get whipsawed out. Why did he tell his clients to buy on pullbacks? Well, maybe because by the time they get his newsletter, then they already missed initial breakouts, so he found a way for them to join the action, and then there's continuation breakout. So it makes you really think, and it's okay to put everything in question. You could always follow blindly a system, but I like understanding it and the reasoning behind it. If that could help me have more confidence in it, and the more confidence you have in your framework, the less you're going to fall into a emotional landmine and alter your framework midway through a trade, which probably the worst thing is. And that's my little thinking out loud about that. All right, Facebook, FB on NASDAQ, stage 2. I know I'm scanning for candidates. When I look at that, it's a stage 2, but with Stan's way. Okay, let's go back. Let's do a little bit of I have previous data here. Okay, let's do the breakout. Right here. Look at this nice breakout in 2013. Ooh, this arrow here. Crazy volume on that breakout candle. That nice launching pattern right here. And even more volume and sustained volume after, and never quite pulled back. Maybe 2 weeks later, you had a chance right here on this candle. But from there on, it was a perfect breakout. RSI going across the midway point, trending higher. Breakout above the 30-week moving average. Seriously, if I would have seen this stock, this is A+. This is type of stock. According to Stan there, it's awesome. Let's just see how you would set. Let's change. All right, there you go. Guys, that's another thing I touched on last episode. Not because here the price action is on the top of the chart that it's the top of the move. Like, don't let that skew your. If somebody would have said, look, 70 can't go higher. Well, it might not. It could, but don't let that affect, because you see, you will see later on that it went a lot higher. So even if it says, I went up 100%, well, okay, why can't it go up 200%? Like, don't even ask those questions. Just see what the price action on the chart says, and you'll be fine. All right, let's practice a little bit. Investors, under the low of the pattern, and traders 4 to 6% under the breakout point. If there's no, I don't know what word to use there, obvious point. So right now, let's say 5%, 10% is 3, so 29. But I think that's too close maybe to the breakout line. Maybe I should just play investors on my sell stops, on my takeaways to go. But the traders, I'd be tempted to at least be protected by the breakout candle, and that's the way I play it on the on my classical chart monthly candle framework. I always put my sell stop below the wick of the candle, the breakout candle, and for me that's how I do it. I guess it would be a compromise between Stan that puts it at the bottom of the formation, and the traders which could be too aggressive maybe, depending. It says 46%, but depends on the volatility of the stock. So, but below a breakout candle, usually if it goes back below that, I want to be out. All right, let's see what happens. Price action goes up, pull back. Stan again, he says he wants to pull back on the initial breakout to be 8 to 10%. But again, these percentages, I'm not sure they mean much now. This might not be a pullback sufficient. So let's just move along. Here, nice pullback right here. RSI giving a V or U. I'd put my sell stop. Traders move up there. Investors right there. Stock goes up. Could have put your sell stop right here under the low. Investors under the, here's my entry, under the 3-week moving average. Okay, Stan says violations of 30-week moving average for traders, you're out. Investors, you can tolerate some move below it, but not if it breaks below the pivot point. Did you mean the pivot point for the investors or for the traders? I ask a lot of questions. I had some reasoning that I was figuring out. I want to try to figure out a way to not sell even for the traders when there's a violation of the 30-week moving average, only if there's a close below it. So all these are pretty much close on it, and I would have just stuck around with it. But maybe that's not the trader's way. I shouldn't do that. The trader's way, if any violation, in case there's a big candle that goes down, you want to get out. So the traders would have taken half of the position here. But first and foremost, did I have a... I did. 1, 2, 3 points. Traders, investors, have your position out right here at this candle. Investors, this green candle, you're out here. Traders, sorry, I'm dyslexic. I inverse a whole bunch of stuff a lot of times. And trader, investors, you're still in the chart. You're still in there. Oh man, I had this other question. Investor Stan says when you start getting out towards the top of a stage 2, well, maybe represented by a trendline violation, you should, investors, they should do the sell stops as traders. So the violation here, the trader would have stayed in, the investor, sorry. I probably would have bailed also. Yeah, let's bail. Because always remember, you bail, but you could always wait for the sideways move to consolidate. And for those 1, 2, 3, 4, 5, 6, 7, 8 weeks that move sideways, you're out. And you're just going to wait for the next breakout signal. Either above, right here, this would have been a nice breakout pattern right here, if you had the volume. And That's another thing also. Do we need volume on those continuation breakouts? From what I've read on stageanalysis.net, yes. But from what I couldn't find it in the stand book, so I'll have to keep digging to try to find a stand book that he wants on continuation breakouts. We absolutely need the volume. It would make sense. A breakout, triple confirmation of breakouts, whether it be in a stage 1 or in a stage 2, but maybe in a stage 2, you don't need the volume anymore as much since it's already ongoing. God, I can't believe I don't have answers for that yet. But I have the RSI going up above 50, trending upwards. Could have entered here, or else there's another one right here. This candle here seems to be a breakout candle. All right, let's move it up. And here you would have had another breakout candle continuing to stage 2. Here you had a little bit more volume than usually. RSI going upwards above the 30-week moving average. So you had nice occasions here. Here, if you weren't sure about it, if this is beginning of stage 3, you would have let it alone. You could have waited a few more weeks, and then you could have entered on this bigger pattern launching up. And price action moves along. Investors, traders, you would have been out. Investors, you could have stuck around. Stan says as long as the 3-week average is still trending upwards and you don't go below a previous sell stop for the investors, you could stick around on if you're close to the 30-week moving average. For me, it seems pretty important, but in his book, it was just like maybe one phrase you had to catch. So it's like you really have to read that book and take notes for every time he gives clues on the actual full setup. So that's how Facebook started off, and you could see that could have been a little nightmare for Stan's Way because of staying so close to the 30-week moving average. And that's why I really want to have that pat down what I'm going to do when I have these little wicks that go over 30-week moving average. Got this big, I guess, a gap down and candle shot back up. Investors, traders probably mostly out. So you could start getting whipsawed a lot here. And maybe because you don't have the volume. Maybe we should have never entered here because we didn't have the volume right here. And this one, maybe one time and then triggered out. All right, so that's what happened for Facebook. And then time moves on. Again, action really close to always the 30-week moving average. A nightmare of a stage 2 for Stan. Maybe not investors, but traders would have got whipsawed out a lot. Here you could have thought this was a stage 3 starting, but it probably was a stage 3, but you had a continuation back to stage 2, which is very acceptable. Did I have my breakout volume? Not really. That's why I'm wondering on the volume on continuation breakouts. It would seem a good idea to have it, but it's not always there. So maybe you shouldn't force it, right? And just go to another stock where you do have the volume for the breakout, like this one maybe. This one had a little above average volume. Which candle is it? This one. But that's not a nice pattern right here. At the buildup of the volume, these 3 candles. See, this seems to be a continuation breakout type of formations that after pulling the 30-week moving average up, move sideways. And once it starts getting close to a 30-week moving average, you have a breakout out of it. Another move sideways. And I just want to see where we are today for Facebook. Is this it? Yeah, okay, we're already back here. What to do with Facebook? Right now, There's definitely some churning action right here. 190, nice round number. This is going to be my resistance for my continuation of the stage 2, if there's one. 176 for 175, maybe just a little bit lower. Right here. That's my breakdown. That's my support. I just put my alert. Let me create some black space. There you go. And we're just in no man's land right now. So either you would have been out since the beginning, the first nice breakout we had at the 2013. Maybe you would have played a few of these continuations, and you would have moved your sell stop accordingly when you had those pullbacks. And there you go. You would have started moving it up. And after that, once the price action started, if there's no valid trend line, would have investors and traders would have topped out here and exited at the 30-week moving average, which is still not bad. There's a lot of plays. Get whipsawed once or twice, you lose 1% of your NAV each time. But when you move up, you get 2 to 3% of your NAV. Maybe sometimes 4% of your NAV, if that's how much you gained up. In the long run, you're pretty good. Don't force things. I say that aloud to you guys, but it's for myself first and foremost. I should not force things. Always wait. Always wait. Been doing this for years, trading since 2006. There's always another occasion. Never happened that there wasn't another occasion. So I don't know why we're always trigger happy. It's a crazy reflex we have. And yeah, this is just a wait and see right now, because now we have a lot of action on that 30-week moving average. Seems to want to close to going up, but we're only going to continue if we have a breach of that 190 on high volume, or else it could just be a false breakout and we'll get whipsawed, and let's see what happens. Maybe the stage 3 is going to become a stage 4. Too early to tell. So Facebook is a candidate for either stage 2 or 4. Let's just wait. All right, guys. Thanks for listening. See ya.